What's up everyone, it's Caddy with MoneyVest. I've got another really juicy and interesting video for all of you because corporate bond yields are also going crazy along with the treasury yields because corporate bond issuances have also skyrocketed, which I want to go over in the month of September 2023. So hope you guys enjoy this video and find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel. Link to our Discord and Patreon is going to be down below if you're interested in joining, and of course getting access to all the buy and sell alerts, options alerts, trade ideas. Everything is going to be included, as well as the members only private videos and our intrinsic value spreadsheets as well. So links are going to be down below. We'd love to have you on board as a MoneyVest community member. So this right here is the catalyst, which basically mentioned that September flurry of fresh corporate debt sweeps global market, and U.S. companies are forecasted to issue $120 billion of high-grade debt this month. Now, that is a pretty big deal in the month of September because this is the highest level since May of 2023, so earlier this year, when we kind of touched at almost $150 billion because, look, the thing is, the market has only so much appetite, right? Right now, not only do we have the Federal Reserve doing quantitative tightening with increasing interest rates and tapering off on their balance sheet with letting go of all these maturing debt securities, but we also have the fiscal department, the fiscal policy, the Treasury Secretary Janet Yellen, and they are also issuing a lot of debt so that they can fund their fiscal deficits, which I went over in one of my other videos. And to pile on to the additional supply, we've also got a very nice buffet of corporate debt. So corporate debt, meaning that companies that want to raise more capital, instead of issuing shares, what they do is that they issue debt, right? So it's basically, if we invest in this corporate bonds, we are basically lending our money to these companies and they're giving us a rate of return. In other words, the yield, right? It's a very similar process to buying government bonds, but instead these are corporate bonds that are being, again, raised by the companies. We're lending them the money. They're borrowing against us and they're paying us a coupon payment, which is basically the corporate yield. Now, these can be 5-year, 7-year, 10-year, 30-year maturing securities. But the bottom line is that they are locking in these rates. And this is actually one of a very clear and obvious indicators that they are expecting the yields to go higher. So they want to lock in these rates as of today. So the only reason why an investor would want to go and invest with these companies as opposed to the US Treasuries, where you can get 4 to 5%, is if you are paying a higher rate of return, right? So if the corporate bond, let's say if it's an investment grade, and by the way, let me just go over, show you guys what the investment grade basically looks like. It's going to be AAA. So these are all the tranches within the rating system, the credit ratings of different companies. So of course, long-term and of course, investment grade kind of falls anything that's over single B, double A3, anything that's above that is considered investment grade. Anything that's BA1, BA2, single B, double Bs, triple Bs or lower, or even in the Cs, obviously is considered non-investment grade or subprime bonds, right, which are basically junk bonds at the end of the day because they're obviously going to give you the highest rate of return, but they also have the highest likelihood of default, whereas investment grade is going to give you the best rate of return with the least amount of risk because these are well-established companies with very strong cash flows, very strong credit ratings. Now, the problem with this obviously is that these still need to compensate for that additional risk because at the end of the day, these are equities, right? These are stocks. These are actual companies that can potentially go under. With the US government, there's no type of risk, right? There's the reason why it's called risk-free is because it's backed by the US government. So when corporate debt is issued, it's usually issued with the yield, which is a little bit higher than the treasury market, right? It's T plus whatever the rate that the company is issuing. So for example, T-Mobile did an issuance more recently. So if I go back to the catalyst here, first of all, let's talk about the global debt markets, right? They're bursting with new deals as September kicks off, with investment grade companies rushing to lock in the borrowing costs before central bankers can raise them further. That's why I mentioned that this is a very, very important indicator. It's a very obvious indicator, right? Why would companies issue debt at these rates? Either they're not expecting rate cuts to happen anytime soon, or they're not expecting rates to not go any further, meaning that they are expecting rates could go further higher and yields could go higher further. So they're locking in lower rates right now so that they can borrow money at these rates that for them on their expectations are lower compared to what they could be in the future. And at least 40 businesses tapped high-grade debt markets around the world on Tuesday, and ahead of a crucial release of economic data and central bank policy decisions later this month. So of course, we got CPI tomorrow, we've got the FOMC later this month, and about half of those deals, over $36 billion of new bonds, were sold in the US, making it the busiest session in terms of deal count and daily supply so far this year. Can you believe that? In all of 2023, this is the busiest session in terms of deal count and the daily supply, according to data, of course, compiled by Bloomberg. And if you come over to T-Mobile, also issued their debt, which is going to be over here. So today's shining example is T-Mobile, which announced that it is wholly owned subsidiary T-Mobile USA plans to sell a pile of new debt with the amounts of rates still left in the blank. So I looked at the filing; they pretty much left it blank, and the expected rate is going to be to 1.63% above the Treasury securities, and these are 30-year notes expiring in 2054. And a spread of 1.63 percentage points would put the bonds at a yield of around 6%. As of the 10-year yield right now, sitting at about 4.5%. So if you combine 4.5% plus 1.6, it's going to be a little bit around 6.1%. Is what the yields that the T-Mobile is willing to pay on these 30-year bonds. Absolutely crazy, right? Because they might be expecting the yields are going to go even higher. They want to lock in these rates at the moment. Now, this right here is Winnie Cesar, global head of credit strategy at CreditSights, says, and I quote, "I would expect companies to be trying to get ahead of any economic data that sends U.S. Treasury yields even higher." And he says that I think we will see a front-loaded issuance month, meaning that they're trying to front-load the potential move in the yields, meaning that they are locking in these rates further before, basically front-loading, ahead of the FOMC meeting, where they could potentially raise rates by another 25 basis points, or yields could go even further higher. And as a result, the companies want to issue that debt before that happens. The month's early wave of issuance comes after the recent slowdown tied to both regular summer trends across the Northern Hemisphere and recent rise in the U.S. Treasury yields. But with September comes a strong seasonal precedent of issuance, according to Cesar, especially for investors who believe that policymakers are close to claiming victory against sticky consumer price gains. And money managers from BlackRock and Pacific Investment Management are starting to bet that the Federal Reserve's tightening cycle is finally ending, echoing a similar sentiment across global financial markets, and companies are seeking to make the most of the positive mood while they can, especially ahead of the crucial events such as the upcoming reading on U.S. inflation data and the Fed's September 20th meeting as well. And finally, this David Nussin, senior investment editor, said that the market, the U.S. debt supply, will continue to spray until the market is flooded. And that's really what's going to come down to, right? Because if there's so much debt issuance happening, the government, the U.S. government, the fiscal department is doing it, the corporate market's doing it, the Federal Reserve is doing it. At some point, you got to ask yourself, how big is the appetite for investors, right? Because if there's no demand, guess what? Supply is going to overshoot the prices to lower prices. Bond prices are going to come, yields are going to continue to go higher, right? Because investors would want to be compensated with a higher yield because of taking on that risk, right? So all it's going to come down to is relative selection and opportunity cost. At one point, it's really going to come down to whether T-Mobile's 6% is more lucrative than the U.S. government's 10-year 4.5%, or if it's worth it to basically invest in equities, simply buy stocks, or other type of bonds. So it's all going to come down to opportunity cost and relative selection if the market continues to get flooded with this oversupply of both government and corporate debt. Bottom line is, yields, in my opinion, are going to be a little bit more sticky. They are going to stay here for some time. We got to prepare ourselves for a little bit of a higher interest rate environment. Of course, 2024, we'll find out whether the Federal Reserve cuts rates or keeps them where they are. A lot of that depends on inflation, which again comes out tomorrow. So we'll find out what that CPI print looks like. But at the end of the day, I think we need to be very patient with the credit markets, with the bond market more specifically, because interest rates, in my opinion, like I said, are going to stay here higher for longer. If anything, I've mentioned before that I wouldn't be surprised if there is maybe another 25 basis points priced in, or not really priced in, but potentially happening later this year by the Federal Reserve. So let me know in the comment section below, what do you think about this? And market's appetite eventually is going to be full, right? We're not going to see a lot of buying activity for bonds because, like I said, I mean, there's just so much the market can buy. And this right here is the quarter to date, or actually a three-year decline in the performance of corporate debt yields. Prices have come down, obviously, because yields have pushed higher. because of this oversupply. And if that continues, well, guess what? The prices are going to continue to come down. It's been mostly flat since May of 2022, although it is slightly lower. But of course, if you do see that oversupply and if corporate debt continues to flood the market, well, then prices are going down and yields are going to continue to go higher. So hope you guys enjoyed this video, found it helpful. Make sure that you drop a like. Let me know in the comment section down below, what do you think about this? And of course, subscribe to the channel. Link to our Discord, Patreon is going to be down below as well. As always, happy investing, and I'll see you all in the next video.